Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, all the markets, not even gold and silver today, appeared to be rolling over, anticipating deflation. Silver trading at new 5-year lows, trading back at a 13 handle. Gold down, really retesting the 1050 lows. And actually later in the morning here, popping a bit higher, but oil trading down to a 35 handle. So what's your take here as we're, about 3 business days away from the big Fed meeting? Is this all just gyrations of the market and everyone getting in position ahead of the Fed meeting?
The biggest news that's out this week is the strain that's been going on for months now in the high yield market, the so-called junk market of the credit market. And, we had a junk fund closed its doors for redemptions yesterday, and there's a lot of strain in this market. And as we're going towards the normalization cycle for interest rates, at least according to the way the Fed is hoping to be able to pull us off, you basically have a small grade fire going on in the credit market, and that tends to lead what happens in the equity markets. Historically, we've seen that pattern, and I think that we're going to see that repeat again, and it's kind of similar to 2007, 2008. The Federal Reserve is hell-bent on trying to normalize interest rates, and you can't blame them for that because of the fact that they've been as low as they have been for as long as they have been. If for no other reason, just attempting to do it is really the logic that they're employing, and they don't have a clue as to what they're doing. They're basically playing a game of extend and pretend, and hoping all along that the markets would really vitalize the global economy and lift asset prices up and save banks and on and on. I mean, we saw that whole cycle from the 2007 through 9 crash, and unfortunately they haven't been able to fix anything, and now they're really stuck. Asset prices are now elevated once again, and now we're seeing the junkiest section of the credit market roll over once again, and that's creating this kind of deflationary wave globally that you can see with the oil prices rolling over and so much damage in the commodity sector, and it's getting its own momentum. And the Federal Reserve is going to probably hike next week. You have sitting with like 95% of polled economists per a Bloomberg survey, and just this morning they're looking for like 75% expectations based on what's built into the futures markets. So the Federal Reserve is stuck. They really can't back off of this, even though the data that Yellen is so famous for saying that she is dependent upon. The data dependency of the Fed is all pointing towards the economy rolling over, with retail sales being weak and all this deflationary stuff we just spoke about. So it's going to be interesting. I mean, we may not even get much of a bounce in the stock market for the next week or so, just as a relief rally after the Fed makes its decision. So we'll see how things go. But it's interesting we're recording this on Friday morning, and although gold was hit hard with silver earlier in the morning, it's now catching a bid, and it's actually up for the 24-hour period. And that speaks to the kind of trading action that we get when there's an initial fear wave of deflation. It went down initially, but now people are buying gold and letting silver just sit there. And that's a pattern that you see on a daily basis when expectations about deflation versus, the monetary historic role of the king of metal, gold being the money of kings and silver being the average person's money. That's more susceptible to deflationary forces, at least according to the perceptions of average market participants. So anyway, next week's going to be, they're probably going to raise their rates and break the markets.
What's interesting about the physical markets here today on Friday is even with silver touching new 5-year lows, demand on the retail side for physical metals really is nothing like it was back in the July to September timeframe. Certainly it's extremely strong. Just this past week, the U.S. Mint has set a new all-time annual sales record. They're up to just under 46 million coins this week. I think they've got one more week's allocation, so it looks like the final number will be just under 47 million coins. And sales are certainly strong, well up from historical levels, but even touching new 5-year lows here today, sales are not as much in a panic mode. Just customers are grabbing every single ounce they can find, like they were in October, September. And I think that's evidenced a bit if you look at the premiums across the industry. They're certainly up from recent lows of, say, early 2015 when Silver Eagles could be found in the retail market for about 2.25 over spot. Right now, Silver Eagles on the retail market are right around $3 for a monster box. And silver maples are a little over $2, right around that level. But it's really not too far from lows compared to the premium spike we saw a couple months back when silver eagles were selling for over $5. Silver maples were selling for $3.50 to $4, and so forth.
So what's going on with the kangaroo, the new coin from the Perth Mint? I saw a recent report that they had sold over 10 million so far. They picked up a little bit of the slack that was going on when the U.S. and Canadian mints were not able to keep up with demand. Are you seeing strong sales now of the Perth Mint products?
Yeah, we are, and certainly that is definitely a point to the discussion just had, that obviously that 10 million coins, that does affect those premiums when there's a lot of investors that they're only interested in official government mint products, typically silver eagles and silver maples. So now when you add another 10 million coins, that certainly helps to ease up a bit of the shortage we were seeing. And really, if you look back when the Perth Mint introduced those kangaroos and sold, about 3.5 million coins in a day, that really marked the peak in premiums and in the silver eagles and silver maples, and headed the market back the other way of the premiums easing a bit. So certainly that probably is a large component of the premiums easing a bit. Perth Mint has since then allocated their coins, but they are still available, and they come at a lower price point than the Silver Eagles, similar to Silver Maples, but certainly adding another 10 million coins over a couple of months here to the market certainly helps premiums for all the coins, as there's just more options available.
Yeah, and it builds upon what we were talking about in the last week's show with the U.S. Mint having easily cranked out a record for this year, and Lord only knows what it would have been were they to make the coins freely available such that there were high premiums in that August-September period and so forth. And it's kind of interesting. Steve St. Angelo over at SRS Rocco had published a report that was up on Zero Hedge today, picked up by the folks over at Sprout Money. And he had spoken to the researchers at GFMS about generic rounds. And apparently, we've always known that GFMS doesn't count generic rounds nor bars in the official investment calculations for investment-grade silver. But it may be as much as 30% or so of the average coin dealer's volume flowing through generic silver products. And that would be pretty amazing when you have a 130 some odd million investment official coin market above and beyond the government coins, when you might be looking at 30-40% increase in total investment demand for just coin products. We were speculating for the show as to whether or not that included bars as well, and it's not 100% clear. But by all things considered, this year probably was an absolute record in terms of investment demand for silver.
Yeah, I would agree with that, and I would say by a wide margin. I mean, as we were discussing before we started recording the show, if you add up all the generic products, and I mean, it's not just rounds, it's 1 ounce rounds, it's 2 ounce rounds, it's 5 ounce rounds, it's 1 ounce bars, 5 ounce bars, 10 ounce bars, 100 ounce bars. There's quite a few generic products, and I mean, from what we see at ST Bullion, maybe not one generic mint or one generic product can compare with the volume of Silver Eagle, but you add everything up, it's well in excess of the Silver Eagle volume and Silver Eagle demand. So, those numbers have been well understated historically, and certainly even going back to our conversation with Tom Power from Sunshine Mint a couple of months ago, certainly as far as investment demand, 2015 has undoubtedly smashed an all-time sales record for investment demand for investment-grade silver products in the physical market. All right, one last thing we should discuss, Eric, before we wrap up the show, is the big news this week that Anglo American is slashing production, and they're going to shed 85,000 jobs, 85,000 layoffs announced here in December, and that's in addition to the 53,000 jobs they slashed in July. You're talking well in excess of 100,000 jobs over the last 6 months that Anglo American is cutting. They're cutting production. So what's your take on the Anglo American news? Is it the first of many to come across the mining sector? And with metals prices suppressed as much as they are, how much more could that impact the supply side as the next phase of the market gets underway?
Well, definitely, we're sowing the seeds of the next bull market by all of this supply destruction. The Anglo-American cut is going to reduce their mines by 55 to 20 within the next year or so. Some 63 or so % of their workforce is what they're talking about cutting now, and that's above and beyond what they already cut earlier. So the restructuring that they're doing is just absolutely gigantic. Most of that action is cutting back in base metal space, but it goes along with the discussion we were having earlier in the call about how the high yield market is reflecting all of this pain in the energy sector and base metals and so forth. And earlier in the year, we had the Glencore pull in on their production for 2016 zinc and other base metals that they're going to be producing. So we're looking at 20% plus reductions in base metals and probably more in silver, and the supply crunch is going to be pretty substantial, even though we are seeing a pretty fast slowdown in global economic activity. The amount of destruction that's happening in a commodity space in terms of forward supply capacity is being pulled offline a lot faster than demand destruction from economic activity falling down the tubes. So, it's kind of depressing to see this stuff happening, and it's also depressing to see it in the context of just policymakers kind of just stuck. I mean, they really don't have any good options at this stage other than formal monetary reset, but that's not going to happen because bankers don't like to give up control until, as Dave Kranzler jokes, they've fleeced the last remaining dollar of middle class wealth that they can take. So anyway, this is going to sow the seeds of higher prices in the future, but it's going to be a long slog, and it's painful, and the commodities are a boom bust industry, and that's what we're seeing now. We're in the period where its sentiment is probably about as low as it's going to get, but it'll take a long time for these markets to turn around. Maybe the absolute earliest, other than $5-10 pricing in of some kind of reflation cycle midway through next year, oil is probably going to continue to be bouncing around here at the most at 50 or something if we have any kind of recovery, with expectations for reflation cycle for central banks. But it's amazing to see. We've got serious deflation forces going on, and the Anglo-American news is just the most recent example.
Interestingly, while everyone in the markets and on the news focuses on the deflationary forces and is predicting gold to 700 and so forth, the commercials and the bullion banks have flipped their net position to the most bullish they've been in several decades, and that's a massive shift from just a couple of months ago when they were massively short. So it really has been a historic shift in the commercials and the COMEX we're talking about, COMEX Gold. So somewhat not too surprisingly, while everyone's focusing on deflationary forces, the banks are taking the other side of that trade and looking for a move to the upside in gold futures prices anyways.
Yep. Should at the very least be a good setup for January, but we'll see. I would have already expected us to see higher prices this month, and we're still sucking eggs. But that is largely the product of people still fearful of what the Fed's going to do. Like we were talking about last week, we're at this stage because of the duration by which this has been priced in. And in terms of the normalization cycle, we're probably going to go up no matter what next week. Well, we'll see.
All right, I think we'll wrap this week's show there, as I'm a bit under the weather here, and I'm not sure how much longer my voice can sustain itself. We'll watch all the market action next week. Certainly should be interesting starting Wednesday afternoon through Thursday and Friday. I personally expect a bit of a quiet start to the week on Monday and Tuesday as everybody waits for the Fed, and then we should see fireworks start come Wednesday afternoon. Buckle your seatbelts. It'll be volatile and interesting, if nothing else. That's a wrap for this week's show. Thanks for tuning in to this week's SD Weekly Metals and Markets.